Hi. We all know what a successful team comprises of. Have some aggressive batsmen who can score those runs quickly in normal times. Also have some dependable players who in times good or bad can score those runs for you. And also if you could have some defense players, who in normal times may or may not score runs, but when it comes in adverse times, they will definitely score. Sounds like a dream team. May not be possible in reality. However, when it comes to your investments, it is possible. As an investor, you can invest in equity asset class, which is aggressive in nature, which in normal times can get you good returns. You can also invest in a dependable asset class like debt, which gives you returns in an expected range most of the times. And at the same time, you can have gold and silver in your portfolio, which in adverse time act as defense for your portfolio. To just illustrate this, we can have a look at the returns that these asset classes have generated over the years. If you can see, right from 2008, which was the time of global financial crisis, there the equity markets cracked by almost 51%. And that was the time that gold as an asset class stood up and delivered positive returns. Again in 2011, when most of the European nations were facing the debt crisis, be it Italy, Portugal, Spain, Greece, they were getting rating downgrade. And this was again the time that equity delivered negative returns. However, gold stood the test of time and gave positive returns. And let's talk about the recent past, right? COVID year. In 2020, maybe what you can see on the graph is positive returns of equity, but that is for the year. But we all remember what happened in March 2020, when equity markets corrected by more than 30%. And at the same time, gold went up by more than 30%. So you do understand how a portfolio overall comprises a healthy mix of equity, debt, as well as gold. And that is what we are here to talk about. The multi-asset portfolio, which is a combination of all these categories. We ourselves conducted a study on the average returns and the volatility of this multi-asset fund that we created. And this multi-asset fund was created with 65% equity, 20% debt, 10% gold and 5% silver. When we observed the returns of this category right from 2007 to 2023, as you can see, the average returns of the multi-asset fund stood close to the equity returns. However, when it comes to the volatility, the returns were exceptional. The volatility of this fund was far lower than equity. And I think this is what gives the added advantage to the fund. So why multi-asset allocation fund now? Outlook on almost all the asset classes that we talk about, equity, debt or gold and silver, is positive right now. Let's talk about equity first. We say that we are now at a decade which could be one of the best for India, be it domestic consumption or manufacturing or infrastructure. Almost all these categories can see rapid growth. Government has come up with very strong reforms over the last few years, be it RERA, GST, merging of the PSU banks, reduction of corporate tax rates, and in fact the latest PLI. These all bode well for the manufacturing setup within the country. And hence, this ecosystem which earlier never existed can get a boost. We also know about the infrastructure spend that the government is doing. We've seen this stress even in the latest budget. Last 5 years, the spend that the government has done on capex has grown by 27% CAGR, which is a very strong number. When you talk about banks, they are at one of the cleanest balance sheets. Talk about the various corporates, the debts right now are very low. So corporate balance sheets are lean. All these bode well for the private capex to pick up, as and when that happens. Last and not the least, we are positive on the foreign investment outlook. The growth that India is seeing in this period stands out sharply in contrast to the issues that are facing the developed countries. And not just developed countries, even countries like China. Moving over to debt, even debt, if you speak about it now, is standing at a favorable debt cycle. We are at one of the highest level of interest rate globally, and the interest rate cycle is peaking. Between March and June, anytime the Fed is expected to cut the interest rates, and even RBI could follow in the latter half of the year. We've also got domestic government bonds inclusion in the international indices, which bodes well for the debt class. Talking about gold and silver asset class. Geopolitically, we are at one of the toughest times. In the last 2 decades, we would not have seen so many conflicts, but what we are seeing right now, maybe at a time 2 or 2+ conflicts going on internationally. These are tough times, and it is exactly in these uncertain and tough times that asset classes like gold and silver do very well. So maybe 2024 could be the time that almost all these asset classes could actually have a positive outlook. And that is the reason we are talking about HSBC Multi-Asset Allocation Fund now. Talking a minute about how we'll be investing in various categories. When it comes to equity allocation, we would be investing across market caps, right from large cap, mid cap to small caps. And even the style would be blend. So it would be a mix of growth and value stocks. When it comes to debt, we would be investing in medium category bonds.
Let me elaborate on the debt part of HSBC Multi-Asset Allocation Fund. The global interest rates have peaked, and the central banks are about to embark on the rate easing cycle. The outlook for Indian bond markets is looking more favorable. The inclusion of Indian government bonds in the global indices and strategic allocation to the Indian bond market is expected to bring nearly $30 to $35 billion inflows in the coming year. The government in the recent budget has affirmed its commitment towards fiscal consolidation. India's CPI inflation is most likely to be in the RBI's favorable band towards the end of FY 2025. This makes us believe that the interest rates will start softening at the end of calendar year 2024. On this backdrop, the investment philosophy of the debt part of HSBC Multi-Asset Allocation Fund has been designed to invest in the government securities and high-quality AAA rated corporate bonds that can generate long-term alpha by active duration management. HSBC Multi-Asset Allocation Fund will focus on investing in securities across the curve, predominantly on the medium end of the curve. Dynamic duration management can capture the upsides of interest rates that are expected to soften.
For gold and silver, we'll be investing through the ETFs. In addition to all these allocations, we also have the arbitrage strategy. So what we are saying is, if at all we develop a very negative view on the market, maybe because of valuations becoming extremely expensive in all pockets, or if we say that there is an event, geopolitical or otherwise, in domestic situation or in world anywhere, then we can take the equity allocation down from 65% to even 40-45% using arbitrage. So that is how we are planning to invest in the HSBC Multi-Asset Allocation Fund. So time to look at this fund. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.